Hello everyone, and welcome to this presentation of 5 reasons why your trading is not consistent. Okay? Let's get on with the 5 reasons that are keeping you from becoming consistent. First of all, the facts are that 80% of all traders lose money. So if we had 100 people in the room today listening to the presentation, 80 of them would eventually lose all their money. And we don't mean you would go into a drawdown or go into some type of slump. Literally, you would lose all of your money that you have set aside for trading. The facts also state that 15% of all traders will just break even. Okay, so if we have 100 people in the room today, only 15 would be breaking even. And that's not bad, but you would have nothing to show for all your hard work that you're putting into the market and trying to learn how to trade. You would basically just be trading water. So what does this mean? Well, it means that only 5%, only 5 of you, if we have 100 people here today, only 5 of you will be consistently profitable. If you want to see what this looks like on a pie chart, if we look at this large section in red here represents all the people that would be losing ultimately. That small slice in blue would represent the people that are breaking even, and that small little green sliver there would just represent the percentage of traders that are ultimately profitable. This doesn't matter if we have 100 people in the room today, 1,000, or if we look at all the traders around the world on the globe. It will always be the same percentage points. So we have to ask ourselves, why is it that only a small amount of people are able to consistently capture the gains in the market while others are able to consistently have profits? Well, it's these reasons that we talk about. And I say this firsthand because I am guilty of falling susceptible to all these reasons when I first started trading. I traded using all of these reasons that didn't help me make any money. I wasn't able to sustain any profits. I wasn't able to get forward on my trading until my mentors taught me what the reasons were. And there were actually 5, and I've come to see in my 37 years of trading that most traders fall to the wayside in their trading because they were employing these reasons. And it's funny because most of the time we have been taught through conventional wisdoms that these are the things that are going to help us become successful, but conventional wisdom is not always correct. So reason number 1 going down in our presentation today of why we are not consistently profitable is because you rely too heavily on news. I know I was taught right off the bat that I should know everything about the companies I was trading. I should know all about the news, every earnings event that came out, any global event, economic report, any jobless claims I should know about, and it's going to help me in order to become a better trader. Well, my mentors taught me that this is not true. And the reason why is because news is subjective. Someone can read the news and say that's tremendously bullish, and you can have another trader reading the exact same news and say that's tremendously bearish. And at specialist trading, we want things that are cut and dry. With all of our rules, all of our techniques, regardless of their indicators or patterns or news, we don't want to have one person seeing one thing and the other person seeing another. So news is not only subjective, it's after the fact. Okay? A lot of times, even if the news is correct, if something that is supposed to be good for the market, many times it happens after the stock or the future or the commodity has already gone up. So we don't want to be chasing things. We want to be more in sync with what the market's doing, and we don't want to be relying on something that is subjective and after the fact. Let me give you an example here, and I'm going to show you a lot of examples in today's presentation. They're a lot older, they may be 1 or 2 years older, but I'm showing them for educational purposes. At the end of today's presentation, I will put it all together with some examples that are as old as yesterday, that happened actually yesterday in yesterday's market. So let's start off with an older example that came out in August of 2012 in the LA Times. And it stated in the headline, Apple becomes the biggest company in U.S. history as its stock reaches $623 billion. Basically, it says that Apple has become the most valuable company in American history. Okay, tremendous news. The company's value rose to $623 billion, beating the record for market capitalization set by Microsoft. The stock has hit new highs recently because of optimism around what is believed to be the impending launch of the iPhone 5 and possibly a smaller, cheaper iPad. So anyone looking at this would say, boy, that's great. You have to buy the stock. And for an investor, you have to hold on to Apple because it's a tremendous stock. It's the largest stock in history, and only good things can come out of this. Okay, so if we look, we see here that the stock had been going straight up. And right here, circled in green, this is where the good news came out, okay? And then look what happened. It dropped 25% in the next 3 months after that, okay? What happened to the good news? Was the good news only good news for the next couple of months? Or was it after the fact and a little bit too subjective? Now, following this, as the stock went all the way from 700 all the way down to 500 roughly in the next 6 months, 3 or 6 months, guess what the news was in April of 2013, just about 6 months later? Apple drops below $400 for the first time since 2011. Apple accelerated losses, tumbling to its lowest level in over a year as investors continue to drop shares of the tech company amid worries over second quarter iPad mini shipments. Okay, now the news is terrible. Anyone looking at this would say, well, that's got to be bad. If I'm an investor, I should probably sell this. So you exit right there around $419, and look what happens. Up 60 points in 2 weeks. And this was an older chart going back to May, roughly about 9 or 10 months ago. We all know that the stock is much higher now. So you see how the news really would not have helped us in any of the situation. In fact, if we look at this chart, here's where the good news came out, way here, up here at the top levels, and here's where the bad news came out. All right? Now, I'm not going to sit here and tell you that this always works this way, that anytime good news comes out, whatever you're looking at will go straight down and vice versa. All I'm saying is that we want something more cut and dry, or something that is a little bit more consistent and not so subjective or after the fact, because this is not going to help us with our trading. All right? Something that works some of the time but doesn't work a lot of the other time is not going to help us. This is one of the main reasons why we're not successful. Okay, let's go on to reason number 2. Why we're not consistent in the markets? Because you are trying to pick tops and bottoms. All right, I know this firsthand because for the first year or two when I was trading on the floor of the stock exchange, this is the way I used to trade. Okay, and it used to work fantastic for a couple of trades, and then it would just work terribly, and I'd give everything back. Let me show you an example here, going back in the E-mini to show you how all this works in every time frame in every direction. Now, this is a daily chart of the E-mini, an older chart. And as we see here, when people try to trade overbought and oversold scenarios, usually what you'll do is you'll use an overbought, oversold oscillator, some type of indicator. All right? This is just your standard slow stochastics, and conventional wisdom tells us that when these two lines cross over in the so-called overbought territory, that's where you should short it. And when they cross over, getting close to or touching the oversold territory, that's where you should buy it. So these two trades worked out really nice. If had you sold right here, you would have had a nice gain of roughly 20 or so points in the E-mini, and had you purchased right here, you would have a nice gain there. So looking at these first two scenarios, this worked very well. I'm sure you would say, well, Steve, what are you talking about? Picking tops and bottoms works nicely. It works nicely. I wouldn't disagree with you at all. It works nicely until it doesn't work at all. Because if we go further into the future, we look at the same chart and see that, well, we got another crossover here telling us it's time to sell. So you would have exited your long position and gone short, and you wouldn't have had any movement to the downside except another sell signal. So you would have doubled up, and guess what? It just keeps going higher and higher until you gave everything back that you made on these first good trades. Okay, does this look familiar to anybody? Anyone who tries to trade tops and bottoms knows that it can work tremendously well until it stops working. And it's not just a scenario where you're trying to short, it can also work where you're trying to buy. Here's a chart in the E-mini from this past week. All right? Now, if you use this same scenario of trying to buy and pick bottoms, guess what? All of these areas here would have been places where the indicator told you that we were oversold and it was time for a bounce. And you would have continued to buy until ultimately you probably would have given your whole account up in 1 or 2 trades here. So you see how this is really a sucker's bet. Trying to pick tops and bottoms is similar to gambling and playing the slot machines. You know, slot machines are probably the worst statistics you have of any gaming type of fun or pastime at a casino, because the odds are so stacked against you. What they do is they give you this false sense of security where they let you win a little every bit, every once in a while, but over time, pretty much you've used all of your money for gambling, because over time you will lose everything. It's the same scenario. It's the exact same thing with picking tops and bottoms. From time to time, you'll have a winner where you think, boy, this is fantastic. But over time, if you continue to use this technique and this method, you will ultimately give everything back. It's a recipe for disaster. And I'm saying this firsthand because this is the way I used to trade. So what's the lesson learned for trying to pick tops and bottoms? Well, what my mentors taught me when I asked them, I said, well, why can't I pick tops and bottoms? They said, because there is no such thing as overbought or oversold. any trading market that you're looking at, anything, it doesn't matter if it's futures, stocks, or the forex markets, can go as high as it wants and as low as it wants, down to zero. We've seen this happen. So there's no such thing as overbought, oversold. This is just a bill of goods we've been sold. Remember, this is conventional wisdom that really doesn't work. So don't ever get stuck in the trap of thinking that something is overbought or oversold. It can go as high as it wants to or as low as it wants to. All right, reason number 3 why you're not consistent in your trading: you are out of sync with the market. We've all been told that you have to be in sync with the market. You have to trade with the trend, but most people have a different idea of what the trend is. So that's why it's so difficult to trade with the trend. Here's an example in CRM this past year. As we see here, the stock had been going straight up, but then it looked like it was rolling over and starting to head lower. So at this point, you say, well, it looks like it's topped out. I'm going to sell it and get out of the stock, and then look what happened. Okay, you're out of sync. It was actually still going up. Or Apple. How about in this older scenario? We see here that the stock had been heading lower, and guess what? Off of news or off of something that happened with the stock, it goes straight up in the next 2 days. So you think, wow, it's time to get into this stock. I'm going to cover my short, or I'm going to start to look to go long Apple because it's really just headed straight up. This is a good sign. And then guess what? By the end of the month, it's making lower lows, okay? Look familiar to anybody? Here's how we can remedy this, by using our buy-sell line. The buy-sell line tells us which side of the market to be on. Therefore, we are in sync with the market we're trading. And all the buy-sell line is the 50-period simple moving average. That's all it is. But what you have to do is plot a 50-period simple moving average on every chart you have. It doesn't matter if you intraday trade tick charts or if you only look at monthly bars. It doesn't matter if you trade the Forex or if you trade stocks. You must always have a 50-period simple moving average plotted on your chart. And in order to use this correctly, what you have to do is ask yourself before you pull the trigger, or any time you're interested in trading, always ask yourself first, where is price in relation to that buy-sell line or 50-period simple moving average? Okay? I'm going to say this again. You may want to write this down. Where is price in relation to the buy-sell line? Ask yourself that before you pull the trigger on buying or selling. Why? Because if price is above that buy-sell line, then you should only be looking for buy setups. That's it. You should never even consider going short. And if price is below that buy-sell line, you should only be looking for sell setups, or you should never consider going long. Okay? Let's look at those examples again. Now, we originally wanted to sell or get out of CRM because it looked like it was rolling over. But if we applied the buy-sell line, we ask ourselves, where is price in relation to that 50-period simple moving average? Price is above. So there's no reason to even consider going short. We should have been looking for buy setups. How about Apple? Originally, we thought, wow, this had a really nice spike up, so we wanted to go long. But if we added the 50-period simple moving average, we ask ourselves, where is price in relation to that 50-period simple moving average, the buy-sell line? Price was below. So if price is below, we should only be looking for sell setups, shorting setups, and we should never consider going long. This is how you're in sync with the overall market. It's the easiest but most powerful way we know of being in sync. And trust me, this will save you out of so many losses. This is one of the most important rules I ever learned on the floor from my mentors. And if there was one thing I could use for the rest of my life, if I couldn't use any other technique or tip that I've accumulated in my career, but I could only use one, this is what I would be using. I really feel so strongly about this buy-sell line. In fact, if we look at that old chart again of Apple, and we see how where the good news came out at the top and where the bad news came out at the bottom, all we had to do was apply the 50-period simple moving average, the buy-sell line. And even if we had taken advantage of buying here and selling here, the 50-period would have gotten us out. We could have exited once we saw that we were below, and we could have covered our short and got long and saved ourselves a lot of money. Even though we would have had losses, they would have been minor losses as opposed to major losses, the way some people who held on to Apple all the way until this news came out down here, and then they sold it at the very bottom. Now remember, this works not only in stocks, the forex markets, it works in the futures markets, the commodity markets as well, and it works in any time frame. Remember the flash crash in May 20 when all the markets just fell out of bed, thousands of points, and people said, boy, there's no way you could have made money on that day. Well, that's not true. Here's an intraday 5-minute chart of the E-mini on that particular day, the flash crash. And we ask ourselves, for that entire day, where was price in relation to the buy-sell line? Well, for 99% of the day, except for a few small pop-ups above the 50 period, the price was below. So this was telling us we should only have been looking to go short. And most of our traders had a fantastic day during the flash crash because we had some great signals that were able to get us to go short, and look at the profits we reaped out of this. Why? Because we were in sync with the market. We weren't trying to pick a bottom at all. The only people that got hurt during the flash crash were people out of sync of the market trying to pick a bottom. All right, reason number 4 that you are not consistent in your trading is because you're not listening to the market. My mentors taught me that. They said, Steve, you are involved in far too many news events. You're listening to too much news. You're subscribing to too many trading gurus. At that time, we had subscription letters. Now they would be called trading rooms or chat rooms because there was no internet then. I had too many indicators plotted on my screen. I was just listening to all these outside things trying to give me an idea of what to do. Listening to my friends and other traders give me ideas and who do you like? What do you think of this stock? What do you think? Rather than listening to the most important thing my mentors taught me, and that's the market. And I said, well, how can I listen to the market? Well, what do I do? And they said, Steve, the market is always giving you clues, always giving you hints as to what it's going to do. And this is the source of what your trading is based off of, so why listen to outside things instead of what your source is, and that's the chart in front of you. So I said, well, how do I do that? And they said, you can start by looking at the most valuable chart pattern there is. And I said, what is that chart pattern? And here it is. It's simply a bar that closes in the top 25%, whether it's a 5-minute bar, a 30-minute bar, a daily or weekly bar. But when you see a bar that closes in the top 25% of its range, the market, not an outside source, not a trading room, not some guru, not some guy on TV, but the market itself is giving you an indication to buy. It's not telling you to buy, but it's giving you an indication that most likely it's going to go higher. Conversely, if you see a bar, whether it's a monthly bar, a weekly, daily, or even 5-minute bar, close in the bottom 25% of its range, you're getting a tremendous clue that the market's most likely going to be going lower. It's an indication to sell. So, as we stated, it's the same thing I asked my mentors. Why is this so important? You may want to write this down. When a price bar closes, either at or near the top or bottom of its range, the market, not an outside source, not a trading room, not some guy you watch on TV, not your best friend down the street who trades for himself, but the market itself, the most important thing you should be listening to, is giving you a clue as to which direction it wants to go. What a tremendous clue. What if the market itself that you're trading, that you're buying and selling, were giving you personal clues? So this is a tremendous, tremendous way to listen to the market. Here's an example in Tiffany. Now in hindsight, we see that the stock literally went up in this example here. It had some really nice movement, and looking back in hindsight, once again, it's easy to say, well, yeah, sure, well, you would have been long the entire time. Well, what if we were looked at every time we had a nice run-up in the stock, and every time it pulled back or sold off, was there some type of clue the market was giving us that it was going to go, an indication it was going to be headed higher? Well, if we look at this first run-up we had here, we sold off after that, and guess what? We had this confluence of all these bars circled in green that closed in the top 25% of their range, followed by 7 points higher. Then we sold off again, followed by these nice bars here that all close in the top 25% of their range, followed by another 3 points higher. Another sell-off, followed by a bar that closed in the top 25%, 3 more points higher. Another sell-off, followed by 2 more bars that close in the top, another 4 points higher. Now remember, this has to be coupled with the buy-sell line. This also has to be coupled with other things, but these are clues that tell you which direction the market wants to go. It wouldn't matter if this were a 5-minute bar chart of Tiffany or a monthly chart of Tiffany. Now let's go to reason number 5, why you're not consistent in your trading, and that's because you are using faulty entries. Many times you actually may be on the right side of the market, you may be not trying to pick tops and bottoms, and you're doing everything right except for your entry. I know so many traders that the minute they have a good feeling about a stock or future, they just jump in. Just jump in, buy at the market without any consideration of where they're buying, to say, I just got to get in. Or else they get scared and they exit and they say, it's time to go short. You got to sell everything. And they could be the right decision, It's just that they're making their decision based off emotion or based off of what someone else is telling them. All right? So here's a perfect example in the British pound for all you Forex traders. Now right off the bat, we're above the 50-period simple moving average. And we see a bar here that closes in the top 25% of its range. Coupled with some other things you may be looking at, this is a buy signal. You want to go long the British pound. So rather than sitting back and looking for a nice place to enter, you just simply buy at the market. And guess what? In the next 3 days, it goes straight down. Now, it doesn't look like a lot of movement, but if you had traded only one lot of the British pound, you would have lost over $1,000 in the next 3 days. So at this time, you'd probably say, okay, I'm throwing in the towel and I'm exiting. And so you would have exited the trade for a $1,000 loss, and look what happens. Okay? So you see, you weren't wrong. It was the right thing to go long. It was just that your entry was faulty. And you entered at the wrong time, you got scared, you threw in the towel just at the point where you probably should have been entering. So how can we alleviate this problem? By using our confirmation method. So what exactly is the confirmation method? Well, it's the verification that the trend has resumed in your desired direction. In other words, if you're wanting to go long, you want to see that the trend has resumed or is going upward. If you're going short, you want to see that the trend is resumed on its downward course. This is your only signal to enter the trade. A true specialist always waits for his trade to be confirmed before entry. He just doesn't simply blindly jump in or try to pick tops and bottoms on his entry. He waits for confirmation. So here's what, in a nutshell, these examples of what confirmation is. If we're buying on pullbacks, we see here that if our signal was generated somewhere around here, we don't want to simply buy at the market. We wait for price to trade one tick above the previous bar's high. And we continue to wait until you see price traded above the previous bar's high right here at this green horizontal, and that's where you enter. And as you can see, once you entered, then the trend resumed. It would be the same thing going short. If we see that the market is falling out of bed and we simply sold at the market here, well, we would have probably gotten stopped out in this little pullback or rise up. Rather than that, we wait for price to trade one tick below the previous bar's low, and that's where your entry is, right there. And you see the trend resumes lower. Now, the purpose of waiting for confirmation is not only to get us in at the beginning of a trend, as you just saw, but also to keep us out of bad trades as well. And this is a great tool because many times it will keep you out of a trade that was destined to go in the opposite direction. So as we see here, let's say that your strategy gave you a signal and you said, well, I'm not going to buy the way I normally do at the market. I'm going to wait for confirmation. So I'll wait until we trade one tick above this bar where I got a signal to go long. Okay? And if you continue to wait, we never traded one tick above the bar. So at this point, you probably would have said, boy, I don't think it was a valid buy signal, and you would have saved all that money. You see how this confirmation technique kept you out of trouble. So let's put it all together. What if we put all these reasons and all these things that can fix those reasons, which I've shared with you, all together and put them together in a strategy that only has roughly about 5 rules? Well, we did. This is probably our most consistent strategy because it is such a great strategy because it transfers over easily onto any market, any time frame. This is strategy number 4. Let me share with you a brief overview of how strategy number 4 works. It is basically designed to trade quick momentum moves. In other words, you're only in the trade usually from 1 to 5 bars. But we have also ways in which to stay in the trade longer once you become a member of Specialist Trading. So if you really want to capture as much points as you can, we teach you ways in which to stay in a trade much longer. Its intensity level being the most intense, meaning that you have to watch every tick, you can't walk away from your computer, and 3 being the most relaxed where you basically just enter an order and walk away. Well, this is right in the middle. It's a 2. So it's a very moderate strategy to trade. Its main indicator, well, there is no main indicator because it's a pattern recognition strategy. We're looking for a specific pattern within roughly 5 to 10 bars. Okay? So that's what we're looking for with this particular strategy. And it's very simple. Once we teach you what this pattern is in our courses, it's very simple and easy to recognize. Remember, this works in any time frame, any direction, any market. I traded it today on a 2,000 tick bar chart of the E-mini, and I had a nice profit today trading it. But we have just as many strategies, signals in the Forex markets as we do in the stock market. You see tons of these every day on daily bars in the stock market. So it's a great strategy. It's probably one of our most consistent strategies, and it transfers over onto any market. All right, so let's look at some recent trade examples using strategy number 4. Remember, it takes into account all the things we talked about so far, the 5 reasons why we're not successful, and all the things, the results we used from using the techniques to alleviate those 5 reasons. Let's start out with some stocks, and let's start looking at FSLR for solar. Okay, this has been in news a lot. It has a really nice movement lately. If we go back to roughly a week or so ago, we see that price was hovering mainly above the 50-period simple moving average. So as you can see, even though we had one close on or below, for all intents and purposes, price was above the 50-period simple moving average. And here we have a bar that closes in the top 25%, plus it met all the requirements of the strategy, which we can't share all of them with you. But the 2 rules we can share with you are actually 3 rules. Price has to be above the 50-period simple moving average, which it was. It has to close above. We have to have a bar close in the top 25% of its range, and then our entry can only be if we trade above it. Okay? So we're using 3 of the rules and the techniques I shared with you just a few moments ago. So as we see here, on the very next day, we would go long if we traded anywhere above the top of this particular day. Well, we opened roughly about a point higher, roughly about 56, so we would have entered right here, and then we all know what happened in the next 4 days, up 18 points in 4 days. Now, we're not saying that you would have stayed in this entire time, but you would have had a profit with this trade, and if you wanted to, you could still be in this with the techniques we share in the course. This was an actual signal that our members took in FSLR last week. How about LinkedIn? Okay, the first thing we ask ourselves is, where is price in relation to the 50-period simple moving average? Obviously, price is below, so we're not even going to consider going long LinkedIn. We're only going to look for shorting examples. Now, if we're strategy number 4 members, we see here that we have a setup bar right here. It meets all the rules in the course, plus we have a bar closing in the bottom 25%, and we'll only go short if we trade below it. Well, the next bar traded below it, and our members got short, and had you been a member, you would have made 12 points in 1 day. How about the E-mini? Well, if we look at this hourly chart, which goes back to the 13th, which was less than 2 weeks ago, we see here that the majority of price coming in was below the 50 period. We have a bar closing in the bottom 25%. We entered on the next hourly bar here, and you could have made 24.5 points in 1 day on an hourly bar signal. How about on a 10-minute chart going back to last Friday and yesterday? This was last Friday. This was yesterday morning's action. Friday started out the day above the 50 period, but then went below it, and then coming into Monday, yesterday, we were well below it. And we see we have 2 signals here. The first one was to go long on Friday, which would have made a quick 4.5 points. No signals for the rest of the day on Friday on this 10-minute chart, but on the very opening bar on Monday, yesterday, we had a strategy number 4 signal to go short, where you would have entered and you could have made a quick 15.5 points in the next hour, the first hour of the trading day on a 10-minute chart. This is actual strategy number 4, sell signal. How about the Forex markets? Well, here's a signal that we actually generated and posted on Twitter, and all of our members who are strategy number 4 course members were able to take this trade. We sent out a signal the night before. But as you can see, we're above the 50 period, so we're only looking to go long Canadian dollar, the Canadian dollar. We closed in the top 25%. We met all the other rules, so we would have entered once we traded 1 pip above the high of this bar and 120 pips in 1 day, which would roughly be over $1,200 in just trading 1 lot. And then lastly, Australian dollar. We're well below the 50-period simple moving average, so this tells us, the overall market tells us, in order to be in sync, we can only look to go short the Australian dollar. We're not going to even try to consider picking a bottom. We see here that we have a setup to go short. We close in the bottom 25%. It met all the other rules, which I'm sorry we can't share with you right now, but I can share with you we are below the 50. We closed in the bottom 25%, and we went short once we traded below that signal bar. And in the next 2 weeks, we went down over 290 pips, or roughly about $2,900, just trading 1 contract. Now, I'm not going to sit here and tell you that every trade works this great, okay? It wouldn't be fair, and it's not true. There are some losers, whether you're trading a 5-minute chart or whether you're trading a daily or a monthly. And there are losers in every market. So we have to ask ourselves, even though these are high probability setups, and we really feel that they'll get you on that road to consistency, can we increase our odds for success even more? Well, the good news is yes, we can increase our odds for success even greater. And this is by adding the PET-D. This is the Primo Early Trend Detector, the abbreviation for the PET-D. So what exactly is it? It's a proprietary color bar algorithm. And what we do is we automatically, once you become a member, you get the add-on which automatically colors the bars anywhere from green to red. And when you get a series of green bars, this is telling you now that the short-term trend is up. Remember, the 50-period simple moving average tells us the overall trend, but the PET-D tells you the short-term trend. Also, when you get a series of red bars, this tells you that the short-term trend is down. So think of the possibilities when you add these two together. When you add this along with the high probability techniques that I just shared with you, you've increased your chances for success tremendously. So how do we implement this? How can we use this along strategy number 4? Well, if you get buy signals, and it doesn't matter even if you're trading strategy number 4, this could be virtually any strategy, whether it's one of your own or another one of our strategies. Once you get a buy signal, only take trades where the signal bar is colored green, because the PET-D is confirming that that's a good signal to take. And conversely, if you get a sell signal, regardless if you're trading one of my strategies or one of yours, only take the trades where the signal bar is colored red, because the PET-D will be in sync with what your strategy is telling you to do. So let's look at an example here going back this last month in SNDK. All right, we had 3 signals here that our software automatically generated for us to go long. Okay, why? Well, because we're above the 50-period simple moving average. Okay, our close was above. We closed in the top 25% in all 3 of these, and it met all the other rules, which I can't disclose now to non-members. But as we see, these 2 signals worked out great, but this one didn't. Okay, so how could the PET-D have helped us? Well, remember, if we're going long, we need to see the setup bar. That's the bar prior to entry. We need to see that it's green. All right, so if we look at these bars here that worked out, they were all green. You see that? And the trade that didn't work out was marked red. So do you see how the PET-D would have kept you out of this losing trade but gotten you into the ones that worked out? Here's another example in Avon, AVP. This was just this last couple of weeks ago. We ask ourselves, firstly, where is price in relation to the buy-sell line, the 50-period simple moving average? Obviously, price is below, so this means we're only going short, and the software generated 2 sell signals in Avon. Now, this one, actually, if you held on long enough, probably would have worked out nicely, but most people wouldn't have. You most likely, once you had this nice blip, would have gotten stopped out if your stop was anywhere up here. Okay? So both of these signals should have been colored red in order for us to go short, meaning that the short-term downtrend was being confirmed as going lower. Well, we see here that this was colored green, telling us not to go short or not to take this trade. So we would have waited and then taken this colored in red, and as you can see, it worked out nicely to the downside. How about Facebook? Okay, this is once again from the beginning of March, just this last 3 weeks. Where is price? Well, price is above the 50, so we should only be getting buy signals. All right. Now we see 2 trades here. One worked out nicely. The next trade didn't work out very well at all. Okay. So we should have, if we added the PET-D, how could it have helped us? Well, we want to see that both of these signal bars are green. Well, the first one was green, giving us the green light to take the trade. The second one was colored red, so you never would have even taken this trade, and you would have sidestepped all of these losses here. If we look at the E-mini, this was on Thursday of last week, just about 4 days ago. We see here that price was above the 50-period simple moving average. We had 3 signals on that day on a 5-minute chart on last Thursday. Okay, right here, this one worked out nicely. This one was okay, but this one would have been a loss. So we want to see the PET-D help us. So the PET-D would have to tell us that all these signal bars should be colored green. Well, this one was colored green, and it worked out nicely. This one was colored green, and we would have had a nice profit. But guess what? This one was colored red, giving us an early warning not to take this trade. And it was good that we didn't, because we would have had a loss. Remember, this will work on any strategy you have or any trading technique. This is not just akin to strategy number 4. If you have another one of our upwards of 10 strategies, or if you're trading one of your own, you can see how well this will work in keeping you in sync on the short-term trend. How about the euro yen? Well, we see here that we were above the 50-period simple moving average in this euro yen trade, and we got a buy signal right here, but it was colored red. Now, this would have worked out for a little bit, but you would have had to been very quick and exit this trade. You couldn't have stayed in it longer. It would have been more, conducive to profitable trades if we would have taken this one to go short. Why? Because it was colored red, and look what happened. All right, so let's review. Let's go down these 5 reasons that are keeping you from becoming consistent in your trading. The first one is relying too heavily on news. Remember, I used to listen to everything, every news event, every indicator, indication that came out with employment numbers, with jobless claims, everything relating to earnings, and it just was too subjective because I would think it was totally positive and the stock or the future would go straight down and vice versa. So it's not cut and dry. And another way is relying too heavily on news is because you're looking for an outside source to tell you what to do, which is the news, rather than focusing on the market itself. So if you really feel that you must focus on news, you take it with a grain of salt. Instead of relying on 90% of your decision-making process on news, maybe cut it down to 10 or 20%, okay? Don't rely too heavily on news. Now, obviously, if you're a long-term trader, if you're an investor and you're looking at a portfolio long-term, sure, you definitely have to take the news into account. I will be the first one to tell you that. You have to know what the company's doing. You have to know the economic situation. But if we're trading and we're holding something for anywhere from 1 day to 2 weeks, there's no reason you should be concerning yourself with news. I never even consider looking at news in my trading. Number 2. You're trying to pick tops and bottoms. Remember, this is a sucker's bet. In my opinion, I know this firsthand, okay? I know so many traders, myself included, who would trade tops and bottoms, and it would work fantastic, and we think we had the holy grail, and then there would be that one trade where it didn't work, and you give everything back. So remember, as people who are trying to become consistent, you want to trade things that are consistent. You want to trade techniques that are consistent, and there's no consistency in trading tops and bottoms. So you should really just let go of any type of top or bottom type of strategy. Why? Because as my mentors taught me, there is no such thing as overbought or oversold. Okay? It's just something we've been sold. But we know that any market can go as high as it wants, and any market can go as low as it wants. Number 3, well, the reason why you're not consistent is because you're out of sync with the trend. Most people want to be in sync with the trend, but they're using the wrong tools to help them. We feel the most powerful tool is the 50-period simple moving average, the buy or sell line, okay? And all you have to do is ask yourselves, where is price in relation to that? If price is above the 50-period, you only want to be looking for buy setups, and you will never, ever be shorting anything above the 50. If price is below, you only want to be looking for sell setups, and you will never, ever look to go short. Now, obviously, and I have students tell me this on a daily basis. Well, Steve, I didn't go short, and the stock went straight down, or the future went straight down, or I didn't go long, and it went straight up. And I said, yes, this will happen from time to time. There are always going to be exceptions to the rule, but we're looking at consistency, which is 2 steps forward, 1 step back. So we're looking for things that will work over time. Remember, we're not just looking to hit a home run and continue to trade when price is below to buy, look for bottoms, and price is above to look for tops. We're not looking or concerned with that. We're looking for things that have a 2 steps forward, 1 step back approach. And when you use the 50-period simple moving average, you'll get on that road to consistency. Remember, it's the one thing I would only use if I couldn't use anything else. The 4th reason why you're not consistent, you're not listening to the market. And when we say listening to the market, we say look at the bars. If a bar closes in the top 25% of its range and it's above the 50 period, it's giving you a clue it wants to go higher. Conversely, if it's below the 50 period and closes in the bottom 25%, it's telling you it wants to go lower. And then lastly, using faulty entries. We know that so many students we have that become members say, Steve, I'm on the right side, but it's just my entry. I'll get in too early or too late. Once you use the confirmation technique, which states that don't buy at the market, but wait for price to trade 1 tick above the previous bar's high, well, then you will be in sync and you'll be having a higher probability chance for entering once the stock or whatever you're trading goes in your direction. So if you get a buy signal, only buy if price trades 1 tick above the previous bar's high. If you get a sell signal, regardless of what strategy you're trading, only sell if price goes 1 tick or 1 pip below the previous bar's low. And then lastly, if you want to kick up and ramp up your odds for success, always trade with the pet D.